So David, a very simple yet loaded question. How do we help people make better financial decisions?
One of the ways that we can help people make better decisions is by giving them some of the basic information that they need to know to understand the decision. Many times we think we know enough when we really don't. And financial literacy training or product knowledge information can be really helpful, which, that's an example of some of the tools of MoneyWise Workplace can really give people some of the foundations to realize that maybe this decision is a little more complex and there's a little more to it, and they should perhaps spend a little bit more time thinking about it. That can be useful. Another benefit would be to have a coach or a second opinion, like a professional financial advisor, because they have experience with decision making, but they also have a lot of subject matter expertise, which can save us a lot of legwork, because we often don't realize how complex something is until we start thinking about it. From 30,000 feet, a forest looks just like a flat green surface. But when you're on the ground in the forest, it's much more complicated. Financial decision making can be the same thing. So we can take advantage of the training of professional financial advisors. And one of the biggest advantages there can be coaching. So just that coaching to overcome some of those heuristics and biases can be useful. So for example, loss aversion is a really powerful bias that impacts us. If you look at what happened during the COVID market crash, the stock market declined 33.9% from the peak, just when sort of the peak was February 19th. By March 23rd, it had declined 33.9%. A lot of people pulled all their money out of the market. There was $350 billion pulled out of the S&P 500. And those people automatically crystallized those losses. That money was gone. What a lot of people didn't realize was that in just the 3 trading days following that, the market went back up 17.6%. And so those people, that was 18% that they were never going to get back. If you had a professional financial advisor or a coach or a second opinion to say, relax, the markets are volatile, it goes up and down, just don't worry about it, those people would have been so much better off. And in fact, by the end of the year, the market was up overall. So having that behavioral coach can really have a positive benefit. And we've actually done research at BEworks on the benefits of financial advice. And we found that when people work with someone else, helping them make those decisions, giving them that coaching, they tend to pick more diversified portfolios, both within asset classes. So let's say you want an equity, you pick more different types of equity, as well as across asset classes. You're more likely to pick equity and fixed income and different types of equity and different types of fixed income, so you get better portfolios. And they actually perform better. At any given level of risk, they actually have a higher level of return, because that second opinion can encourage us to make better decisions and create better financial outcomes as a result of it. And part of the problem here really is that people don't understand what that is. So there was a study that was done that showed that behavioral coaching alone can increase portfolio returns by 2.02% per year.
Wow.
Which doesn't sound like a lot, right? 2%, big deal. If you compound that over the working life of the average person, call it 40 years, that's enough to more than double your portfolio at retirement. In fact, it's 122% higher. That is like a life-changing difference in what your retirement is. And it's as simple as just having someone giving you some coaching, giving you some support and some ideas. And that's critically important.
And I appreciate that you mentioned MoneyWise Workplaces, because that is our foundation, is educating people on the basics, but it is working with that advisor. And I remember hearing those news reports. This is worse than the Great Depression. Is it like, that's where an advisor comes in, your type of research comes in as well, to say, look, don't lead with emotions. Like, you need to understand the data. What can we take, what more can we take away from that?
Yeah, it's, again, it's the loss aversion. It's a natural response. We tend to think very emotionally before we think rationally. And we don't realize that we're making an emotional decision for something where we really should be spending more time and effort making a rational, analytical decision.
Right. Oh, great advice. Thank you, David.